In 1968.
We went backwards in time? I thought we'd keep going forward to 80s and 90s. You're going backwards now, 1968.
In 1968, the band released music from Big Pink.
He died. Sorry, go ahead.
Yes, he did.
Yeah.
And I mentioned that
Very
because this week we lost Robbie Robertson, a key member of the band. Of course, the great Lee Von Helm we lost a couple of years ago, the drummer and singer of the band. By the way, you're listening to the On the Tape podcast. The person that interrupted me was the great Danny Moses, back from Halls they call that in Europe, like holiday. Dan Nathan is in Colorado, I believe, as we're doing
Maybe
this.
he's up on Cripple Creek. That's the band, right?
That's the band.
Anyway, yes,
Up
he could be.
Cripple
You know what I'm
Creek.
doing? You know what I'm doing? I'm putting Dan's glasses on. You know why? To stretch them across my white head. So he's going to go nuts.
He's going to go nuts.
And let me tell you something else, just so the viewers understand his kind of OCD. If things are out of place, look, Dan, I'm spinning a pen on the thing. It's facing the wrong direction. I have a water cap here that the bottle doesn't belong anywhere. So anyway, please, go ahead.
But you're back. And by the way, we're going to have a conversation with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. The last time Lori was here was in October of last year, and she painted a pretty good picture, which, by the way, has come to fruition. So we'll discuss that with her. Now, you're saying, all right, Guy, once again, you're off the rails. Podcast hasn't even started yet. So let me explain this. Robbie Robertson, a great singer-songwriter. Fantastic. I don't think people appreciate his guitar playing. Fantastic. One of the great guitarists of our lifetime. But the song that everybody knows is The Wait. I pulled into Nazareth, was feeling about half past dead. And Nazareth is Nazareth, Pennsylvania. Martin guitars are built.
Okay.
And that you don't know these things. But the song, if you listen to the song and the lyrics, maybe we'll put the lyrics in the show notes, Danny. It tells a story. And for me, and for everybody, music is different. I hear that song, and I think this is somebody that's looking for, not retribution, but is looking to find something that's pure, that's always fighting against a lot of different factors. And I hear The Wait. I feel as if both you and I, and Dan Nathan as well, have been carrying this weight around. We're looking for redemption. We're looking for the light. We're looking to help people. But along the road, we meet different, Crazy Chester we meet all these different characters in the song. And each time we're sort of thwarted. Does that make any sense whatsoever?
Yeah, it does. I always like, you take me on this thing. I learn something.
I take
new
you
every
on
day.
journeys.
Yeah, you do take me on journeys. And so, yes, a lot of uncles and crazy things that are going around. Right.
So as we're on this journey together, we're walking down this path. There are no straight lines in life. I went to a Jesuit university, and one of the things that I learned in my Problem of God class in 1982, there are no straight lines in life. And as much as we want to make what we're trying to do linear, we're trying to get from point A to point B, unfortunately, along the way, there's some detours. The same way if you listen to that song, there are obviously detours. Great song. So rest in peace, Robbie Robertson. But how are you, Danny Moses?
I'm good. It's good to be back. Being away for a week, you really kind of get away from it. You can see things a little bit more clearly.
It's good, though. It's funny. You were away. I'm not going to say where you were because if I say it, I'm doxing.
You did it already.
And apparently,
but yeah,
I don't want to. I shouldn't dox anybody anymore.
Yeah,
I learned things from you as well.
Yeah.
But you called me. You had like an epiphany about a week or so, like out of the blue. I get a call from Danny Moses. Like, I have clarity for the first time in a while. Sometimes, by the way, you need to take a step away in order to get clarity.
To see the field. Exactly. And so we had talked about the Bank of Japan for weeks, for months. And then, obviously the meeting on July 28th, I was already gone. And then it occurs, and there's a little bit of confusion exactly what they did. But they basically raised the range of where they're going to let their yields trade up to 1% potentially, though they already panicked at 60 basis points. So I started thinking, and I called you. You're the literally only call I made, I think, the whole time I was
that.
I said, I realize now, which statement of the obvious, but yet we started this global central bank experiment with Japan years ago, in the late 80s probably, Guy. And then we took the baton, obviously, in 2008, and then the ECB and everything, and BOE, whatever, print. What Japan is doing now, because they finally have inflation, right? And I'm watching the yen here as we sit here weaken to almost 145. And by the way, for you technical chart people out there, we're starting to hit a very dangerous level. And what they're going to need to do in order to defend their 10-year yields to keep them contained now that they're inflation. We saw a glimpse of this in the fall of last year with the Bank of England. Right? We saw a glimpse. How dare you try to...
Which lasted 2 weeks.
Right.
And they lost the prime minister on the back of it.
So it feels to me, and I'm sure I'll be wrong because we'll figure out a new way to print money, which we did during the banking crisis in March, just called it something else. We are at kind of the end of things, meaning because inflation, yes, it's coming down, but it's still very high and may prove to be a little bit stickier with what's happening with energy prices here. You can't print your way out of this any longer. And so that's the realization I think that's about to start occurring. And these experiments, which are starting to kind of not work, right? And I don't know. It just seems like we're seeing a little bit of a shift. Forget about the S&P and the markets for a moment. It just feels that way to me. So I
agree with you. Now, one of the things that I've said for a while, so the Bank of Japan started this whole charade decades ago. We caught on to it as well, we being the United States. And obviously, we're still the largest economy in the world. So what I think, and I say this, I'm curious as to your thoughts, I think one of the many unintended consequences of our, and I'm going to use the word reckless Fed, is that we opened the door for other central banks to act in kind. So along the way, on this road to devaluing your currency and all these different things, when everybody's doing the same thing, what happens? What's the end game there? So to your point, there's going to come a point in time where it all stops and somebody has to pay the piper. But my point all along has been, in the race to zero, there are no winners. Everybody's headed towards that same cliff. And I don't know where we are in terms of getting to the cliff, but the cliff, it's there. Like, I can see the friggin' cliff. And everybody's running towards it in the form of these central banks. And sometimes it's too late to stop that mass exodus.
So your point is well taken, because with the U.S. dollar is the world's reserve currency.
For now.
And if you were going to print like we did, you had to have other people participating or the dollar would have gotten absolutely destroyed. Right. It wouldn't have worked. It worked because other people did it. It becomes self-fulfilling. You're going to keep doing it. While I was also away, Fitch downgraded, the U.S. rating.
Now, it's a stop there.
Yeah.
So what did you make of that? Because a lot of people said, you're 10 years late. Where have you been? Blah, blah, blah.
It's meaningless, whatever.
It's not meaningless.
No, that's what they say.
I don't know. I know that's what I know you don't believe that it's meaningless. I don't think it's meaningless. I think they're late to the dance. But if you actually read what they said, all the things that they're bringing forth are things to be concerned about.
It's 100% right. And so the things you should take away from that, forget about, does it trigger anything in this moment? No. Is it a wake-up call? Yes. Our deficit and funding this debt as rates move higher, I don't think people realize every day that goes by, a new paper is issued, our interest costs are going up, and it's going to eat up all of our budget. So again, back to the fiscal responsibility standpoint, I don't care who gets, I don't care, but whoever gets into the White House and whoever controls Congress next year, there's no tax cuts coming. There's no fiscal stimulus probably coming because you won't be able to do it. So I'm saying all those normal things that you can pull, the levers that you can pull to create. We did this IRA, right? This, which is obviously spending money into the system.
Inflation Reduction Act.
Right, which in the system, and you can do these things. My point is that I don't think that there's anything normal about coming out of something like we've done here with this global central banking experiment. It is what it is. And I'll say it again. I was against it in 2008. In hindsight, it was the right thing to do because nobody, even us, knew the depths of how this thing was globally attacked, right? So I get it. The TARP, the TALF, the PPIP, the DED, yeah, all the acronyms. They're going to run out of acronyms eventually that were done, yes, but we never paid the piper from
exactly.
that. We never paid the piper.
Listen, I didn't know. We were doing Fast Money at the time. We were in our early innings of Fast Money. So we would come on television for 6 or 9 months having to explain something that had never been done before in the fiscal history of mankind. I mean, they were pulling things out of thin air, and we were trying to talk about them. So I didn't have a problem with them trying to stem the tide and stop the bleeding. My problem all along has been the duration with which they stuck around, and the fact that our economy here in the United States got addicted to these types of different things. And it's not it's the weaning off that kills you.
It was the Bernanke that we used to call him.
Something.
He is the one. I don't want to waste time speaking about it. He was the one. We could have gone through iterations of pain, I believe, in 2011, 2012, 2013, and we just didn't. We just didn't want to feel it. We did a QE2 and QE3, but we didn't do it. And so, can the S&P keep moving higher? Sure, we can inflate all assets. I'm just talking philosophically about what I'm seeing and what's happening is just let me be very clear. If the global markets start to lose faith, the central banks either in their ability to have or lose any type of credibility, there are multiple contraction points coming in this market.
Last week, the name of our podcast was Turning Japanese. You know the song by the Vapor, and I brought it up because of everything you're talking about right now. So let me just stop for a second and say, I don't think we're paying enough attention. I think you agree. Dollar-yen, if dollar-yen were to meaningfully get through 150, 150, you got to start saying to yourself, there's something amiss there. And the market is starting to call bullshit, not necessarily call bullshit, but is starting to push the Bank of Japan. Like, you want to play this game? Well, we're going to push you into this corner. You want to continue? We're going to continue to push you into the corner until something breaks. And it's happening in slow motion until it happens all at once.
You know what else is broken, Guy? This whole algorithm AI game of, not AI as it relates to stock valuations, AI playing on every CPI print and every economic data point print and how it basically creates, right, just from words that hit the tape or numbers that are input into a system on how a market's supposed to trade. The danger, and I'm looking as we come on here today, the 2-year yield and 10-year yield are trading north of 10 basis points in ranges. I don't think people realize this is like the new. That's insane. Okay,
it's insane.
So it's insane.
Stop for a second.
Yeah.
This is the United States you're talking about.
Right. The most liquid market in the world are U.S. Treasuries.
Should be the most liquid. And yet they trade, and I've said this, so people get tired of hearing me say it, but it's important to point out. Treasuries trade like biotech stocks. $100 million biotech stock with one drug in the pipeline that is contingent upon some sort of FDA approval. That's what it trades like.
Well, let me just say this.
Which is crazy.
Let me just say this. If you're an astute trader of bonds and equities and you're patient and you have a thesis, right? Nothing changed today from that CPI number, right? It just reaffirmed the expectations, right? If you're bullish, you don't chase on that print. You wait for a pullback to buy. If you're bearish, right? If you're bearish, you sell into the news today because it hasn't changed anything. But nobody makes money in trading.
They get
pre-market.
chopped up.
It's crazy. So I see that, and it's, I just had to mention it because this can't continue. That is a chop up. You are basically destroying, I think wealth is maybe too dramatic, but you're destroying shareholder money when you try to trade something like that.
Whilst you were gone, and I'm going to trigger you here, I don't mean to, but I'd like your thoughts on this. Bill Ackman came out and said he's effectively shorting the bond market. Now, he did that, or I should put it this way. The announcement came, at least for the short term, what wound up being the top tick in terms of 10-year yields, like 4.2%. And then 10-year yields backed off, but they're starting, to your point, they're getting back on their horse. I happen to agree with him. I mean, I don't find myself agreeing with him a lot of times, but if the yield curve steepens, but it steepens with long-term treasuries going higher, that's a bear steepening. I mean, I don't get wonky here, but that's not a good thing.
Question is, sorry, so why people speak their book and something like that? He hasn't learned his lesson, going after. And listen, if Icahn still had $1 left after what's happened to him, he probably would have come out and just taken the other side.
That's a whole other story.
We can talk about that in a second. More importantly to me is not where yields are going, it's why they're going there.
Fine, fair enough.
If you're telling me that yields are going to move higher because the faith in our ability to pay our debts, turn out the lights. It's game over.
Well, they're not going higher because the economy's getting better.
Well, no, I understand. But
I know you understand, but that's important. Distinction.
If you're a bullish person, you say yields are going higher because the Fed's going to be cutting and we're going to have a no landing or a soft landing scenario and we're going to be able to continue this kind of growth above average growth. Now, I'm not in that camp. But I also believe when you see moves like this, like we saw in oil a couple of weeks ago that took out a macro fund over in the UK, I believe, right? This stuff gets out there. The last thing I would want to do right now is talk my book on a macro basis. Now, I don't know the size that Ackman's putting on. He wants a little PR. He feels a little ignored. He wants to come out and splash around. Great. And you know what will happen? Yields will be at 370s. I got out of that. I was already out of that position here. But don't get me started.
When you say splash around,
I don't know.
But immediately I think of, we talked about this, that scene in Rounders.
Yeah. When splash the pot?
Yeah,
splash the pot.
I'll splash the pot.
Yeah.
It's John Malkovich.
Yeah.
And of course, not Ben Affleck, Matt Damon says, don't splash the pot. And Malkovich is getting his ass kicked by Matt Damon.
Yeah, maybe that's where I got it from.
I love it. Don't splash. I'll splash. Anyway, I digress as I typically do. I don't know how big his position is. And to your point, I don't know why he came out or felt it necessary to come out and say those things. But it doesn't mean he's wrong necessarily. And I think that's important. So
Okay.
you got to watch the bond market. If 10-year yields start to grind high, and I'll tell you, if you want to play our home game, 91-ish in the TLT, and you can say it's not a great instrument. It's not the point. That was the low we made back in October, which correlated to about 4.25 in 10-year yields. And that's where we could potentially push down to. And if 10-year yields start to push through 4.25 at the same time dollar yen starts to go through 145 and all these different things happen, I don't know. That's not a particularly rosy picture.
Who's the largest foreign owner of our?
I think that's China.
Nope. Number 2. Who's the largest? Japan.
Japan.
Right. So we won't see for another few weeks if they've been selling, which, by the way, if you need to defend your currency or you need to buy your own, what are you going to sell?
You got to sell something.
Those are the things I'm talking about, like this intertwine. But anyway, we can move on from there. I want to talk about another name.
Please.
Okay, completely shifting gears here.
I like downshift.
One of my favorite.
Can you drive
I'm actually going to upshift and start the car.
Like if I bought you a 1968 Chevelle with 4 on the floor.
Yeah.
Is that
where the gear shift is actually on the dash or is it down in the middle?
No, it's down here in the middle.
Remember the Corvairs had the things
a Hearst on the floor.
Yeah, I would do
Bruce
it.
Springsteen
I really
song.
loved it. So on Market Call on Tuesday, I've harped on this name a lot, and I'm not even involved in the name. And who cares? It's a couple billion at this point, $3 billion market cap probably. Upstart. They're using AI for lending, a lending platform, right? Personal loans, and they're doing auto loans. Now they're getting into home equity loans, and they're adjusted. They made a little bit of money, but credit's going to be an issue for them. Guy, they're actually moving down the credit scale right now to grow their business. In this point in the cycle, I find that interesting. But I just wanted to see this one thing that I saw off of their conference call, if you could just humor me for a second. Because I didn't actually listen to the call, but I went back and looked at the transcript. They think they've broken through on lending. And let me just be very clear. I've said all along, and Vinny used to say, you cannot commoditize lending. If your loan book grows faster than GDP, you will have issues. You have not figured anything out.
When buy now, pay later came out, you called bullshit on it. That's 2 years ago.
All right. So
there's nothing new about
So what they're trying, so they're dependent, just for people that understand, UPST, they're dependent on getting funding in order to basically make the loans, and then they balance sheet them and or sell them, right? So the loans perform, they can originate them, we got this cool platform, we're going to sell them. Well, over the last several quarters, they've been forced to keep some of those loans.
Because they can't sell them.
Correct. And the ones they sell, are the best. But here's a new thing, and then we'll move on. I just love this stuff. I want to share an exciting breakthrough. We're calling it it's something we call parallel.
Hold on a second. You're doing that in your You're doing that in your strip joint
more DJ,
voice.
I think.
Okay.
More 2 for Tuesday.
But I liked it anyway.
In this slide, I want to share an exciting breakthrough, something we call parallel timing curve calibration. Okay?
Stop for a second.
Yeah.
What is that?
Parallel timing curve calibration. They basically are going to run AI models on simulated portfolios on how they believe that their loans will perform from a delinquency, whatever. I saw something like that. You should sell. Honestly, you see something like that.
That's
You're coming
what happened.
up when you have to basically anyway. When you want to validate why your business you think is going to start to make money by something like that, right? You've reinvented. People, there is no reinventing lending. It's been around since the beginning of time. You cannot commoditize it. You cannot use AI to. What you can use AI to do is tell me what my delinquencies are and my loss rates are, because that's what you're going to be reporting.
Well,
anyway,
again, playing the home game. What's today? August 10th, I believe.
Yes.
So tomorrow, when you hear this, I'm saying tomorrow, but it will be today when I say tomorrow. So it's Friday, August 11th, folks. On August 1st, Upstart, UPST, was a $72 stock. As we're sitting here, it's a $32.50 stock. No, but it's
I mean, listen,
it's
remarkable.
remarkable.
It's the reason it's a $2.7 billion market cap. So the reason I mention it is high short interest. Reddit's got it. Get out of the way. Here we go. Now, if you're a short seller and you got squeezed, it is what it is. You had to protect but this is what's gone on. Short sellers are evil. Are they? Because the short sellers were giving you the playbook. Short sellers are wrong because the stock goes up and that's how you get graded. But to me, this is the stuff. Like, this is where you have to be paying attention.
They point out some of the now we're going to talk. Since you mentioned Icahn Enterprises, we'll talk about it. By the way, Upstart was a $400 stock.
Oh, I remember that guy. I can't remember the guy's name.
2 years ago.
Yeah.
The fall of 2021.
Yep.
So, I mean, there are all these crazy things that have been going on. Let's talk about Icahn Enterprises because, once again,
they changed the samples. They used another provider. They changed their dividend. You saw that. That was what happened when I was gone. Another fun thing happened.
But, does this mean any? I only bring it up because Carl Icahn is obviously a legend. Like, remember in the movie in like Ocean's 13, they talk to Carl Reiner and he's at the dog track,
Yeah.
right? Matt Damon, or not Brad Pitt goes
I
to
actually
see
have a
him.
credit on that movie. Go ahead.
No, you don't.
Yes,
do
I
you,
do.
right? Brad Pitt goes to see him,
Yeah.
and he's trying to talk him into doing something. He's like, "You're in the Hall of Fame already. You don't need to do this."
Right.
Say right.
Right. Well,
And I've said
people
this-
don't change who they are. I get it. But
That's
no one's
exact-
ever challenged him like that.
Well,
Nobody.
then, but this.
Hindenburg.
It's being challenged.
Yes.
But it's being challenged not in the papers it's being challenged in the stock price.
So we know people, I will not name them, whose parents or retirees own this. And this is why I talk about things like this, because I want people to be aware that don't listen to your financial advisor that's probably getting a fee to sell it that looks like it's a 20-something% dividend. Oh, look, this is great. This is great. Hindenburg's point was that you're not earning the dividend, right? That Icahn has pledged his shares as collateral on this. And guess what? He got outed, got challenged, and the trade went against him. What has he done? He's cut the dividend. He's changed his collateral. And I would not own this thing here. Again, do you go out and short it? No. It's in the mid-20s. Guy, where's this thing? Somewhere hanging in the mid-20s.
24 and a half.
24.
So just for it went from
50.
a trough of 18 in May. I think it doubled. Not that means anything. And now here we are at 24 and change. That a miserable week. But I guess the point that I look at this and say, it's not about, this is Carl Icahn's company. I mean, this is his
thing. And
this is his legacy.
He even said, and he was forced to, I think, say, I was wrong, I was short the market. There's another guy that capitulated. Listen, he's a smart guy. Forget the structure of this thing. You're right. Icahn has seen twice as many cycles as you and I have, right? He's been through it, right? He's an activist. He's still active. His ego got ahead of him here, I think. But anyway, my point, you brought up Ackman. It made me think of Icahn and all this. But my point is that yield's not real. I remember the subprime companies when we were shorting them in 2005, right? The bar was difficult.
All right, so stop for a second.
Yeah.
You saw something in 2005.
Right,
Now,
but I'm not correlating that to what I'm seeing
But
here.
my
Right.
point is, like, you saw, and again, I talked about this with you when I went and watched The Big Short, how upset I got and how I knew I'd be upset because I knew it was going to happen. And when you have clarity like you had, but when things still move against you, that's extraordinarily frustrating. And I look, I'm not comparing myself to you, Danny, Vinny, Porter, Vinny, any of those guys. What I'm trying to say is my level of frustration is exactly that. Like, I think I have clarity, yet things continue to happen that frustrate the shit out of me. Anyway, please.
No, the comparison was that the implied dividend yields on those companies, New Century or Credit Home Lenders, remember, they structured themselves as REITs. They found this loophole, right? But it was just mortgage-backed securities. They were implied 20% yields, 30% yields. We knew it wasn't sustainable because
Insane.
anyone that has a 20 or 30% yield is, unless it's a pipeline company, it's not sustainable. We know that. The short interest was 30, 40, 50% on it. So it took a lot of guts to say, all right, we're going to go short these stocks. Well, what's interesting is that we knew they were going to zero, right? But you had to time it. And if you're wrong by 2 or 3 quarters, you're paying 25% short interest. So just in 2 quarters alone, that eats 12.5%. The implied dividends or the paying dividends are another. So you're down 35% before, hold on. The beauty of the accidental phone call from Greg Lippman or Jared Vanette or Ryan Gosling, whatever character you want that came in, we were debating at that moment. How do we maintain this positioning? How do we put this trade on, express this trade, and not get killed? And then the trade came to us where he says you can pay literally 2%. So we were comparing a 2% kind of basically coupon that we have to pay out being short, right? Credit default swap on that bond, so to speak, to pay. We're like 2%, and we're shorting it at par.
Sign me up.
Sign me up. So for us, and everyone had a different reaction, for us, it was opportunistic trade. There was a no-brainer because we knew if those companies failed, that the underlying bonds or mortgage-backed securities that they were issuing were going to fail because they held them on the balance sheet. It was the same. So my point is that when you see those things in its entirety, and you can paint the mosaic and see, I'll bring it right back to not necessarily Icahn, but to the meme stocks and to these things. You know when things are not sustainable. So when you feel and you want to be a retail trader and you want to go into Reddit and you want to, buy these stocks that are out there because they have high short interest, let's go get them. People, there's a reason that they have a high short interest. So it just doesn't just happen overnight. Like, is that a technical reason to own a stock? If you have a fundamental reason to own, 100%. If you believe that AMC is going to have 22 Barbie movies come in the next whatever, fine, more power to you. But you get my point, guy. It's just you got to pull back and do the whole mosaic. It's not just about those because if you try to time a technical, short rally, so to speak, or short covering, you're going to end up getting, no one's going to time that right.
But you have to have the thesis behind it, and you have to have the courage of your conviction, and you have to have the clarity. But it's one of those things like that herd of wildebeest are still moving forward. You know they're headed towards that cliff, but you want to get in the way of them, no. You have to allow that to take place. Just a question of, where is that cliff for the wildebeest to run themselves off? Because invariably they do. We're going to talk to Lori Calvasina, and I'm sure passive and active will come up. And here's one of my concerns all along. For example, Apple, and don't at me if I'm off by a couple, is in 347 ETFs. Apple is one of the top 15 holdings. So as money flows into these ETFs, a lot of people don't even realize they own Apple. Chances are, if you're in the market, you own Apple, which, by the way, has been a fantastic thing over the last. I'm not saying it's not been a good thing, but that can turn very quickly. And Apple, you probably didn't see. I'm sure you looked at the quarter. Now, 3 quarters in a row of declining revenue, declining. I mean, it's slowing down.
Yes,
which is fine.
Yeah.
I mean, it happens. Stock made an all-time high, I want to say last week. It obviously reversed. Now it's trading in the mid-170s-ish. Valuation is still stretched. My concern is when passive investing becomes active, it ain't going to be active on the way up. It's going to be active on people saying, holy shit, what's going on here?
Yeah.
And that gets dangerous. So it's great on the way up. It's scary on the way down, if in fact that's what we're on the cusp of.
Listen, I've said on this podcast many times and in other places where I've talked about why did the move from active to passive happen, and it goes back to the same reason that people's in-laws are in Icahn Enterprises,
right,
is that the brokers drive that. And what do I mean? Brokers stopped getting paid years ago on mutual funds. They stopped the fee structure so that the golf outing for Eaton Vance and take your broker out. I didn't call you guy and say, hey, you know what? I think these Eaton Vance mutual funds are for you.
By the way, we're just using Eaton Vance as an example.
I'm using I don't even know if they're even whatever. Whatever.
Yeah.
I'm not using that as yes. So you can strike that, whatever. I'm using that as an example. But my point is that when that changed, how the brokers got paid changed. How do brokers get paid? Now the majority of them just charge a fee off of the gross asset. So if you have $100,000 with someone and they charge you 1%, you pay them $1,000 a year. They don't charge you on a trade for commission. They will incent you to buy products where they're getting some type of fee on the back end. But my point is that when you own an XHB or an XLF and you think you're diversified, or your point, the Q is that you're diversified, you need to look within. I can tell you without looking at the XHB right now how the builders have performed versus Home Depot and Lowe's. I don't even know what the construct looks like right now. And to your point, Guy, this was all new money flows coming in. No one asks questions when the markets are going up. It's always when they're going down. What happened? How did that go down so much? I thought I was diversified. And so I'm not saying the brokers got lazy. The brokers adjusted kind of to the new. But I know a lot of old school brokers that do both, that are out there, and they're actively trading options, trying to protect portfolios. They're active. Those are the ones that you want, the ones that have a brain, the ones that are thinking, not just asset gatherers that are getting a fee. Point, Guy, because it all moved together.
Yeah,
everything kind of moved together. So
and there's
pay attention to how people are incented.
There's
in
safety
life.
in numbers, 100%.
Yeah.
Let me throw this out. Credit card debt, something we talk about in this country. You just grunted. It's a staggering number.
Staggering.
So what's happening here is we are combating inflation with layering on more debt. Think about that for a second. Inflation goes higher. How do we combat it? Add to it.
It doesn't work. That recipe does not.
Doesn't work.
Those cookies don't taste.
But why isn't any? But nobody wants to.
They don't want to. They don't want to think about it, Guy. It's right to your point. Who's left to point those things out? Oh, you're just a bear. No one cares until they care. How many of these crises in the last 3 or 4 years we have these intermittent battles with things coming out of nowhere, supposedly, right? They're not out of nowhere. They're out there. They just haven't come to the forefront yet. And when they get to the forefront, they become self-fulfilling. Perfect example, go back to this Japan thing with the yen. All of a sudden, when people realize, wait a minute, that's why the yen's weakening? I thought risk was back on.
No. Well, that's interesting.
Sorry.
That's really interesting you say that.
Yeah.
Because historically, this is sort of a risk-on environment for that. But something is changing.
Correct.
That pendulum is swinging the other way.
That's my point.
And it's going to go from the all-time carry risk on, all that bullshit you hear all about, to it's going to change to a risk, and it's going to happen quick. And it's going to start there. It's happening. And I think it was last Friday, and I apologize but I think it was when you were off. you had a big rally in the market, or 2 Fridays ago.
I didn't pay attention to whatever day that was.
Because the Bank of Japan wasn't as draconian in that BoJ meeting that we had talked about a couple podcasts ago. Doesn't mean anything was solved. It just means it wasn't as bad as people thought.
Okay, it's funny you say that.
Well, it's not funny.
I was on an overnight flight. I'm not going to dox myself. I was on an overnight flight that had TV reception in the middle of the night. The only thing that was on was CNBC Asia. It's the only thing I could find. That information was coming in live as I was. I'm like, oh, let me see what this guy's on. Looks pretty dovish. Looks like they're really not doing anything. I'm like, really? I'm like, I don't have it in front of me. I guess I'll go with what this guy's saying. And I'm watching in real time Japanese 10-year yields trade from 48 or 49 straight up to 61. And I'm like, this guy's missing something, because they obviously said something. And they're reading in real time, like, we will maintain around 50 basis points. I said, okay, so 25 is not now the low, 50 is the low. I wonder what the top is.
Stop for a second, because you're right. Yeah. The market traded on that. The market wasn't paying attention to the fact that the bond market said, you know what? Shove it up your ass.
Exactly. I'm going to test you.
We're going to test you.
And then I later in the flight, half paying attention, someone mentions 1%. And I'm like, whoa.
Where'd that come
from? We will defend if we ever get near 1%. I'm like, okay.
They've just moved the goalpost.
Right. They moved the goalpost. So this yield curve control went from 25 to 50 basis points to 50 to 1%. By the time I landed, they were already buying their bonds back at a 60 basis point. Yeah. I mean, so the point is that no one can take pain. Right? It's crazy. And so these are the things that we try to help people, educate them. And I haven't even talked about the markets or anything like that. I will say this, that, I watch the Fed fund futures because I think it's the driver, and it tells you kind of the behavioral finance aspect of what people are looking for. And maybe I should put on Dan's glasses and stretch these things again. But in the course of today, we have pulled forward now the odds, and maybe it's even changed since we started recording this, and odds of a rate cut in January from 32 to 38%, and in March from 59 to 64%. So let me be clear. If the driver of the market of being bullish is that the Fed's going to be, we're pretty much starting to price that in. We have less than a 10% chance of another rate hike anyway. So again, what leads us to the Fed actually cutting?
Yeah,
we just went through.
What is going to
lead us to
Think
that?
about that, because the unemployment rate of this country is benign. It's unbelievable. Great. Yep. It's a great employment picture. Credit markets haven't seized up, so you have to and you should ask yourself this. This is to the audience. What is taking place? Now, the bulls will say, it's easy, guy. Inflation will continue to come down, and they'll be cutting on the back of that. I'm not sure about that, Kimosabi. That's not what I look at. So, again, that's what makes markets, Danny.
I will tell you this. This I am 100% certain of. Or I should say 99. No one should be 100% certain of anything. So I mentioned before there was a couple funds that blew up on the oil trade when it got down to 65. And what happens is, so people out there understand, there is no hidden thing here. All the brokers that are the ones that give the lines of credit and house these assets, whether they be currencies, energy, whatever it might be, agriculture, stocks, whatever it is, they're watching their risk parameters, and they make the call, and they make the tap on the shoulder to the right. What have we gone through in the last 3 or 4 months since Silicon Valley blew up? What have we gone through? The big banks are obviously on watch, not just from Moody's. The big banks are on actual watch from the regulators, their shareholders, and everybody. They cannot afford to have these, quote, blow-ups. They cannot afford to have Archegos happen with the family office. Cannot afford. We will see. It moves like we just saw with the yen. When the yen starts to blow out and get weaker, what is causing that increment? It may just indeed be as simple as hey, guess what, hedge fund? You're out of your position. You're levered 3 times, you're out.
You got to cover.
But let me explain. The Long-Term Capital, the greatest book ever written, was not The Big Short. The greatest financial book ever written is The Rise and Fall of Long-Term Capital When Genius Failed. And when I was away, we had someone call and say, hey, can Danny tell us what his favorite book is of all time? It's The Rise and Fall of Long-Term Capital When Genius Failed. And let me tell you, because it's all behavioral finance. It doesn't matter. I'm going to tell you this. The best part of that book was that they convinced the brokers to do business for free, to not charge them commission, because it was such an honor to see what they
John
were doing.
Merriweather,
come on, man,
and all the Solomon guys.
That's
no, but think about the.
But they took them out, is my point. They took them out.
Think about the scope of long-term. I think it was $300 million. Or what? I don't even know.
Levered, it was massive, but
it was. But in terms of numbers we talk about today, we'd laugh about long-term capital. Now I understand it's many years ago, but still.
But they had Russian ruble, sterling. They had all these cross, trades on. They had, they were using Vega They had Myron Scholes walking around in their offices. No, I'm not kidding. Or
I know.
Byron Scholes, whatever his name.
It was Bill Boutte, Merriweather, all the Solomon
Rosenfeld,
guys. Yep.
all those guys that came from Solly. But my point is that they can be the smartest guys, and they're brilliant people. Merriweather has since done other funds and whatever after that. But my point is that like they were taken out not because the trade was going to be wrong. They were over levered to the trade and it went against them, albeit even for a brief time. And that's, Guy, what we're going to start to see, I believe, in various pockets. And that's the scary thing because no one knows where the bodies are buried on this stuff. The brokers have a pretty good idea. So pay attention to that because you'll start to hear, oh, that person got carried out on that trade. That person got carried out. Could be in the bond market, right? Could be currency market.
I think we're foolish, not we, us, but I think the market is foolish not to pay attention to Fitch. I think the market is foolish not to listen to some of these Moody's comments. I think the market should be watching what's going on in Japan. I think the market absolutely has to watch the re-steepening of the yield curve here in the United States and the continued nonsense that goes on in the bond market. And I think you'd be foolish if you didn't watch some of these. I got to tell you something. We talked about this super microcomputer stock, which went from 100 to 350. I mean, they didn't say particularly good things about AI. Stock went down 30% in a heartbeat. You want to go back and listen to or read what Taiwan Semi said. And we're coming up to, I think, one of the most fascinating earnings releases in the history of mankind.
On August 23rd?
In the form of NVIDIA. Yeah. That is, get your effing popcorn out. Because some crazy shit's going to happen. Mark my words on that one, Danny.
I don't disagree. Then we go right into Jackson Hole from there, and we'll see. It's going to be a wild, I think, back half of August and a wild fall for sure. In this
Great
market.
to have you back. And football season is on the horizon.
Yep.
And we're going to talk about that. I know Dan's going to he's have a conniption.
He won't want to pay attention. We'll probably have to create a separate
That's right. You and I will do it together. That's
exactly,
fine. I don't care.
Right.
And by the way, if you remember last year, early on the Eagles, and then everybody got a
very good.
Jacksonville Jaguars. I said playoff team. People are like, what the hell are you talking about?
I think the Super Bowl champ's coming out of the state of Pennsylvania this year. That's what I believe.
Okay,
I believe it's
fair
Steelers
enough.
or Eagles, but maybe a little too soon on the Steelers. I don't want to give away my preview, but I think that could be the Super Bowl matchup. You're getting 100 to 1, I think, on that matchup right now.
Oh, you really?
But you know what I'll give you? I'll give you this right now because I want to make a bet. Let's do a gentleman's.
I don't bet, but go ahead, give it to me anyway.
I'll let you bet Daniel. I don't even know what the odds are for being MVP of the league.
I'm not saying
I'll give you 100 to 1.
I am not saying he's going to be the MVP
we're done.
of the league.
We wrap it up here.
I'm telling you that Daniel Jones is going to have a statistical breakthrough season.
Fantastic.
By the way, nobody's paying attention to this. The Giants have very just orderly rebuilt that offensive line. Evan Neal is going to be a stud. Andrew
University of Georgia.
He's already one of the top 2 or 3 tackles in the sport. The kid from Minnesota, Schmitz, at center is going to be a stud. And then they have some guards that can play.
Adami. That guard Adami is pretty good. Yeah.
There's no Adami guard.
Anyway, wrap us up. Get us out of here.
When we come back, our conversation with Lori Calvasina from RBC Capital Markets. So as I mentioned at the top of the show, we are now joined by Lori Calvasina, head of U.S. Equity Strategy, Danny, at RBC Capital Wealth. You may recall, actually you do recall, that she joined us on October 14th of last year at the balls lows of things and made some pretty prescient calls. I don't know how to spell that, but I know it means she was way ahead of the game, Danny Moses.
Yeah,
so it's great to have her here.
Lori, welcome back. Remember last time I told you we're both children of professors, right?
Yeah.
So we're both from the South originally. We both made our way up here. We don't know what we're doing.
Yeah.
Somehow we made our way here. But welcome back to On the Tape. And you were actually pretty, I wouldn't say bullish, but in October you're like, this, I don't see, it's not going to get a lot worse from here. You think this could be a face-ripping rally. And I went back and listened to the episode, and you got a lot more right than wrong. But a couple things I want to get into here that have happened out of sequence, potentially, that have occurred. And maybe starting with the present, and then we'll work our way back, the things that you're kind of look at. The most interesting thing that I think that you've done that no one else does, I don't believe, is when you're looking at PE multiple expansion or contraction, you're looking at inflation expectations, and most people are obsessed with interest rates.
Yeah.
And you think that's more of a byproduct. So CPI came out this morning, right? It's moderating. You actually had said last year that we would end at 2.7% at the end of 2023. I think that was your prediction. You're going to be right on the money there too, unless I'm mistaken. So let's start with today's print. and then what is it telling us, and then let's work our way back and where you'd be allocating from here. So.
Yeah, so it was interesting watching the market reaction to the print today because we sort of had these initial moves and then they all faded. And when I was getting in the car to come here, there wasn't all that much going on sector-wise. And I think, when I've talked to our rate strategists, they've said we're kind of entering into this boring period for the Fed, which is an equity person I love because I'm tired of talking about the Fed. Right. And I think it was a good print. Our CPI heat map is still all pretty much green. Things are heading in the right direction, a few wrinkles here and there, but I don't think we really learned all that much that was new. It's headed in the right direction. We'll see, exactly where it ends up at the end of the year, but I think we're at that point, right, where the Fed can pause. And people are generally, whether you call it a pause or a skip in September, that's really where the pricing is. And there's not too much to fight about for the next few months.
But you had said you thought that deflation would start to occur sooner, and now it looks like it's going to happen potentially later, and that's a real risk to the markets. And I don't think people understand how that can hurt earnings, and they just think that, no inflation's good. No, explain that to people because I think that's part of the crux of your thesis.
So, I'm a data nerd, right? And so we've seen that moderating inflation and moderating inflation expectations boost PE multiples. We know that from studying the 70s and early 80s. But what we also know is that when you moderate inflation, it pulls your revenues down, which pulls your earnings down. And the flow through to margins, in my back testing at least, is not direct. What's been interesting has been this reporting season. We have finally started to see companies acknowledge that. Now, it is not the dominant conversation, but I would say maybe like 2 or 3 weeks ago in the transcripts I was reading, I saw a bunch of companies say, hey, inflation is moderating, costs are getting better. We're not going to be able to push pricing the way we were. We're going to have to start cut pricing. And I don't know that a lot of investors picked up on it, but I think that's one of the next big debates we're going to have on Wall Street is what that means to earnings. And it's good for the multiple, right? But we are going to have to probably pull earnings expectations down a bit because of that moderating inflation.
Well, the margin improvement has been robust. I would imagine if that takes place, the margin contraction will be equally to the other side robust.
Well, I think what's interesting is margins have just become, I think, almost impossible for people in my seat to predict because things that worked 10, 15 years ago when it was all about these macro variables, they just don't flow through anymore. And the reason for that, again, if you go back and read these calls, companies had the trade war, then they had the pandemic, they had the supply chain crisis, inflation, and they just are really, really good at managing around problems. It's harder to manage around a loss of revenue. So I think that's going to be an interesting challenge, a problem they can fix except for, kind of a pullback on demand.
So let me push back for a second. Not push back, but ask you a question. Your current earnings estimates for 2023 are still $219, is that?
I'm at $220. I pulled it up a whopping $1 the other day.
Can you explain, so where are we going to finish second quarter, do you think? What will our cumulative earnings be? We're north of $100 in first and second quarter. Where are we going to be?
So I don't do the quarterly estimates. I just put out the full year ones. And we've come in a bit ahead of consensus on the 2Q numbers. We're about 90, last I checked the numbers, we're about 90% done with the S&P. What you typically see in most years, earnings forecasts start out way too high. If you start looking at them the summer before the actual year, and at this point in time, the middle part of the year, you basically see estimates stabilized.
But we're at a range. There's people at 185 up to 235, and for this point in the cycle or this point of view, that's a huge, obviously, gap. I don't have to do the percentages on that. So now the question is, and this is the big question, is the trough versus the inflection versus when. I don't think 219. If you told me that 219 or 220 is going to happen, I'd be a lot more bullish on the market because that would tell me that. I know we haven't only had 2 soft landings, 1966 and 95 or whatever the years were that occurred. That doesn't seem to jive necessarily with a 42.50 end of S&P. It does on a 19 multiple, but walk me through that because not that you're playing both sides of this, it just seems like if we get to that 219, that means things are actually okay, in my opinion.
Well, I think where we're sitting with that 220 right now in the consensus, we've seen the 2Q come up a little bit better and the 3Q and 4Q have drifted down a little bit. But I think what companies basically do when they get to the middle point of the year, they just have to make it a couple quarters, right? They just have to manage a little bit longer.
Until we use 2024.
Right. And look, I think that the comment on market performance and what that means, I think we're kind of done with 2023 earnings at this point. I think we basically priced in recessionary type earnings conditions at the October low of last year. And if you look at a rate of change year-over-year stock prices against year-over-year earnings, you've seen post-financial crisis that stocks have really been leading earnings trends. And if you looked at the depth of the decline in the market around, kind of the end of the third quarter of last year when we were hitting those October lows, and if you do the math, it was basically implying about 180 on S&P earnings for this year. I don't think we're going to get at 180 on S&P earnings, but that's what we were baking in at that point in time. So, of course, now it's coming in much, much better, but that's already reflected in the market. And so if you assume that forward-looking relationship endures, what are we pricing in right now? You're basically pricing in a little bit better earnings growth in the recovery that's baked in to next year's estimates. And so, I think we've had this optimism emerge, right? Okay, the bottom in earnings is happening. It's not going to be that bad. 2024 is going to be a recovery year for earnings. That's kind of already in the stock prices. So now we need to get that number up, right? We need to get incremental excitement about 2024 to really get the market going in the back half.
I too think the Fed's a bit of a sideshow at this point, but there's no denying what they've done over the last 18 months. Now 525 basis points of hikes. So here's my concern into the fall of this year. I think you're starting to see a reacceleration of inflation, and there are a couple different indicators that lead me to believe that, coupled with and almost simultaneous with the lag effect starting to kick in from these 525 basis points of hikes, which I don't think is particularly friendly environment for stocks, but that's the lens I'm looking through. Does that make any sense at all?
It does, but I'll tell you, we did some new work maybe a week or two ago that doesn't alleviate the concern about lagged effects, but says maybe they're a bit farther off than any of us think. And if you look at the effective interest rate paid on mortgages, so not the new mortgage rate out there, right? What we're all paying on those of us who have mortgages already, it ended 2Q at about 3.6%. It's creeping up, but very, very slowly. It is going to take time for that to work its way into consumers, and it's probably not going to be 3Q and 4Q of this year. Same thing if you look at corporates. We've seen over time that companies have just ramped up the amount of long-term debt that they have. Only 2% of S&P companies have average weighted maturities between 0 to 2 years. I think it's only like maybe 24% that are even that 2 to 5 year window. And if you look at the effective interest rate that companies are paying on their debt, I mean, we calculated it 3 different ways. And one measure we came up with, which is probably the most accurate, is 1.7%. When we looked at a simple median, it was 3.1%. So again, I think you are going to have those lagged effects come in as companies refinance, but it's not going to happen in the next 6 months.
So effectively what you're saying is, without even realizing, for a lot of these companies already hedged against this a year, 2, 3 years ago.
Yeah, even beyond that. I mean, it was really, when interest rates were sitting around 0, if you went to your typical sell-side conference, right, the analysts were yammering at the companies like, you need to go out and refinance your debt and lock in low rates and do buybacks and all this other stuff. And that's exactly what they did. And now we are reaping the benefits of that. But it is just a very unusual point in history because we've never seen the long-term debt as high as it's been right now relative to total cap. The short-term debt has just been, it's just minimal compared to history.
And now we're competing with Treasury issuing more bonds. We're competing with the Fed unloading bonds. Gerard Cassidy talks about this. It's very hard to kind of gauge that with the banks and deposits leaving and so forth. But more importantly, if the S&P is 4,500 and that's where we're going to stay for the next 4 months, your job is not necessarily to predict the S&P. It's to predict the sectors within it that are going to be working and not working. You said last year that people were much too defensive in terms of how they were positioned coming in. You were right. People were overweight banks and energy coming into the year, and they quickly where we sit now. I think I know what your answer is going to be, but if you had from scratch and you're allocating right now into various sectors, what are you underweight? What are you overweight from?
So I think the problem with positioning right now, it's really a question of your time horizon. So I think in the short term, the growth trade is overbought. It's too expensive. And I wouldn't say people feel great about it, but they've been begrudgingly pulled on the bull train. If you look at the CFTC data, NASDAQ futures positioning is up around slightly higher levels than what we've seen the last 5 or 6, 7 years. So it's stretched. Growth is at peak valuations relative to value again. It's corrected a little but not all that much. So we have a tactical problem on the growth trade. I think I think, look, we're in the midst of kind of a classic recovery trade. We had a recession bottom. We didn't end up having the recession, but we're still in that recovery mode. This is what always happens towards the end of recovery trades, is the initial leaders hand off to other parts that have to catch up. So we've got to have that catch up on the value side. But then we go back to our earlier discussion. What does the recovery look like next year? We've already baked in a lot of recovery. GDP right now is forecast to be about 0.6% and then 1.9% in 2025. When you're below trend in GDP, guess what works? Growth stocks, not cyclicals. So I think we're going to have this catch-up trade in value, but I wouldn't totally abandon all your growth stocks yet. If you can stomach it, I would ride it out, because you're going to need them for the longer term. I think this is just going to be very, very choppy. So you want to own the best of value, which I think is probably energy at this point. And I think you want to own the best of growth, which I think is classic tech. And I think semis are really interesting.
Let's talk about energy, because energy's gotten back on its horse. I mean, depending on what lens you look through, the OIH, which in the middle of June, I think was 245, made a 4.5, 5-year high earlier this week. A lot of these highly levered energy stocks have done extraordinarily well over the last couple of weeks. So the run has been happening, but I think you would suggest that there's still legs. I think there's a lot of legs left. The underlying commodity is showing signs of life. Gasoline very quietly is back on its horse. Heating oil, all the products seemingly doing well. There's a lot to like about the energy sector.
Yeah, and look, it's cheap in both small cap and large cap. In small cap, at least, it tends to be a recession rebound play. Not so much in big cap, but I think there's a case to kind of moving down the risk spectrum. And I always love to watch earnings revisions, the rate of revisions to the upside. It's a great gauge of earnings sentiment. Now, that is very negative for energy, but that's predominantly about 2023 numbers. If you look at what's happened over the last few weeks, the anticipated growth rate for energy in 2024 has actually moved up. So people have kind of adjusted the 23 numbers, but they're leaving the 24 numbers alone or raising them a little bit. So there's optimism on that 2024 building. And just the rate of upward revisions, just kind of all the mechanical adjustments you're making right now, it's a negative number, but it's very, very stable. And if you look at oil and gas, it's near historical lows. That is kind of a classic hold your nose and buy signal. Only we've started to see the performance already move. But I think to your point, we haven't really even begun the process, too much at least, of pulling those numbers up.
I've often said that if energy doesn't work from here, then we're in a lot of trouble, because it probably means that the economy or global economy is slowing, specifically China. We know that this data is being ignored. I'm sorry, but it's being ignored globally. I think of we're not relying. We're still very reliant on China as a demand and as a supplier. So how do you think about China? If you really look at that directly, I'd love to hear your thoughts on China.
Well, look, I probably have a slightly different take on China, which is, I was traveling in Europe back at sort of the end of April, early May, and I was talking to a lot of global investors, and they were all extraordinarily bullish on China, but investors over here were starting to worry a little bit. And you still had European companies that were very positive on China and U.S. companies that were giving you a more mixed picture. Now, I'll tell you, this reporting season we just went through has been pretty uniformly negative in terms of the China commentary. I would say like 75% or so. I think that the global investment crowd got, very anti-U.S. in the second quarter, kind of early second quarter, and then that trade started to come off, and we started to see flows shift. So European equity flows turned negative. China flows had been positive, then those started to shift. There were outflows from the U.S., those started to come back. So, I think the negativity on China, is still, I wouldn't say it's new news necessarily, but I think it's still unfolding in certain circles, and I think that's benefited the U.S. from a flow perspective.
I agree, but in real time right now, in the third quarter, so we just saw second quarter get ripped, but third quarter, things are getting progressively worse, it feels like, in China, not improving. So just to push back on that, I would say it's not, and this isn't, I'm making a bearish or bullish call on the S&P as it relates to China. I just don't know where the incremental growth globally is going to come from. We're talking about Brazil. That's what we're relying upon. I'm just saying, where is the incremental growth going to come from? Because normally it's one-off, someone goes through a cycle. It doesn't feel great on the macro.
No, and look, I talk about this, kind of global weakness issue, right, as another reason to buy small caps in the U.S. And I've described it as sort of when I was coming up in the business in the 2000s, I called it the gospel of global growth. We used to pour through financial statements. This was before we had all these fancy tech tools, and we would actually have to go through and look through the 10Ks and find the international revenue exposure by country and type it into Excel. But it was, this idea, going global was good. That was how you grow. I don't think that's true anymore. I think this whole thing we're seeing from the Inflation Reduction Act and the Infrastructure Act, I think we're reinvigorating domestic economies, especially here. So small caps don't have as much China exposure, right? I think that's both good in the short term and it's good in the longer term too, just because of how things are shifting.
Great point.
Very quickly, it's going to be the fall, and the election cycle is here. So there are a couple things. It's not a two-part question. It's a question. There's a lot of geopolitical risk out there. I don't know how you can ever gauge for that or sort of plan for that. But China, Taiwan, China and Russia last week, 11 warships in a joint military exercise off the coast of Alaska. I mean, that's not particularly bullish. So China, Taiwan is out there without question. And then this election cycle in the United States is going to get really weird really quickly. So I don't even know if it can be a traditional election cycle forecast based on what's going on.
It's a great question. Someone asked me the other day, they said, when are we going to start worrying about the election? And I said, it's already started. And the reason I think it's already started is because the international investors I speak with have all been asking me about it. And they're asking me, things like, what are RFK's chances? They're getting really granular in some of the data and looking at the different candidates. I think the broader topic of geopolitical risk, unfortunately, everything I've seen over the course of my career, we're just not really able to price these things in advance. You saw it back in the, kind of the 30s and 40s when we were going into World War II. We have a great chart on that time period and how much the S&P dropped. And what you saw basically was there was a little bit of a decline in the S&P before Hitler went into France. Mm-hmm. But then when Hitler went into France, that's when the bottom really fell out. How could you wait that long to price that into markets? But nevertheless, that's what happened. We saw the same thing with Russia-Ukraine. I have the privilege of working with Halima Croft, and she was running around for 6 months telling people, shouting, at the top of the roof that this was going to happen and getting really frustrated that people weren't listening. We did the exact same thing again. We did get a question on, China and Taiwan recently, and that's what I told them. I said, we just can't really price it until it happens.
No, it's interesting because Halima was talking about that, but we were talking about, I remember the summer into the fall, we were saying that the Russians have basically amassed 100,000 troops on the border. We talked about on this podcast.
This was a year and a half ago. You're talking about 2021.
They're not there. They're there for a reason. Nobody's paying attention to this. And I thought they would invade after the Olympics. Turned out they did it in the middle of the Olympics. That's neither here nor there. Halima was on this as well. I think the same thing is happening right now with China. I mean, it's obvious if you're paying attention with the rhetoric.
All right, before I get too depressed with all of that, I think I would include within the geopolitical risk central banks.
Yeah.
Because it's not life and death per se, but it is from an economic perspective. And I think the one thing that's being lost in everyone, there's no more printing. There's no more really with inflation, which is still, yes, it's come down on a relative basis. It's still high. It's now growing in Japan. We see what's happening in the UK and in Europe. And to me, that's the scary part because people can ignore these things. We've ignored a lot of bad stuff in the last 14 years because of the central bank's ability to print. That to me, and you probably can't answer this because no one can quantify it, that to me is this back to the fundamentals and the bottom up and all the stuff that's going to matter, which is the stuff that you do. And I think your case on small caps is absolutely spot on. How do you think about the global central banks and their role in this with liquidity in the marketplace?
So, it's come up in conversations this summer on inflation, right? If we sort of have a higher for longer situation in terms of inflation, you're going to have to endure more aggressive central banks for a while. I will tell you, I've been surprised and heartened that a lot of the portfolio managers I talk to, they're kind of okay with it. It's not that they love it, but I think this era of easy money has pushed a lot of money into passive, and it has made it very, very hard to be an active manager when it's pushed everything up and to the right. Mm-hmm. And so I think if we have more traditional economic cycles, decision-making by actual human beings is going to matter a whole lot more. And I think people are starting to understand that. So they'll take sort of the pain that's associated with that higher inflation, that higher rates, to have a more enjoyable job. Walk
me through this transition back from passive to active, because I thought we were there last year and it kind of got pushed to the wayside again. That will be a painful burning back through the atmosphere move, because to your point, everybody feels, I'm safe in numbers. I got these ETFs. I have all this. But when they're forced to really look at it that way, I think that's going to be very difficult.
I just think it's been very, very difficult to beat the benchmarks, right? When everything is going up and to the right and you have these mega caps just swelling and swelling and swelling, and portfolio managers, right, they have caps on how much of this stuff they can actually buy. So if you really have to go in and have more winners and losers and more dispersion within the market, the active manager matters more.
Let's talk about the small caps because a large portion of them are typically these regional and small banks. Yeah. And obviously, many of them bottomed out March, April of this year for obvious reasons. And the absence of bad news, until recently at least, they've been sort of levitating. But you're starting to see, I mean, obviously the Moody's note. I mean, there are a lot of things that give you concern about maybe the health of regional banks. I understand on a valuation basis, but a lot of people think there's another shoe to fall. If you're in that camp, it's going to be a tough slog in small caps, I think.
So, this was something we wrestled with over the summer. And I went back and looked at the history of how small caps perform coming off recession lows and what the sector leaders are. And it's interesting because in large cap, if you look at the S&P 500, the financials, obviously a lot of that's driven by the banks, are typically recession recovery outperformers. You don't actually see that in small cap. They do well and they go up. But I guess my point is there's precedence to have a recovery trade in small cap in dicey economic times when financials are not leading the way. So the way I reconciled that in my head was I need the financials to settle down. I need them to behave. I don't need them to lead the way. It's areas like industrials, consumer discretionary materials that are typically those recession kind of cyclical outperformers. And if you look across the sector landscape, small versus large, pretty much everything is cheap in small versus large. I think the only two exceptions are staples and utilities, but you actually see some of the most robust valuation gaps in things like industrials, in things like consumer discretionary. So you can do the math to get there without them.
Just on the banks in general, everything's been backwards in this cycle, right? They get punished on holding treasuries and mortgage-backed securities and the mark-to-market of those, right? There's not been a credit cycle yet. Yes, we've had credit in commercial real estate. That's not happening. But I think you've written about this. All the other areas within small cap are directly affected by banks participating in the markets and funding and lending. Yeah. That's contracting right now. It's not off of a cliff, but it's contracting. So banks are being a lot more selective because their capital ratios and all the requirements are going to start to get even harder and harder. So to me, how do you factor that in? Because I don't think there is a playbook for the order of things of how this has happened.
Yeah, it's a great question. It's probably one of the most consistent pieces of pushback you get, especially from kind of private bank type clients who do regularly do those allocations into and out of small caps. And I would say two studies that sort of gave us some comfort was number one, we picked apart the small cap balance sheets, and we found that they're in pretty good shape as well. They've levered up, in terms of long-term debt. Don't have a lot in that 0 to 2 year window. They do have a bit more in the 2 to 5. I forget the exact stat, but it's a lot is sitting there. So you do need the Fed to start cutting, but there's a window of time, right? We've got a couple years before that's going to be a massive problem for the small cap space. The other thing we found that I thought was, really more interesting, and we put this together probably around April or May. If you look at the small versus large trade, just a relative ratio, it tends to bottom out right around or a little before you get peak tightness in lending standards. So we kind of looked at it, the SVB issue, and said, okay, well, if we just accelerate that tightening and bring it forward, that's actually good because it brings that bottom and small cap performance far, brings it forward in time. And I think it just goes back to the idea, why does that happen? Because small caps just trade everything early. So by the time things get really bad in terms of the lending environment, you've already priced it into small cap. And I think, we've been horrible there since 2021, so...
This is where I pause and tell the listener they can't see because it's a podcast. There's no.
What do you mean? They're on YouTube. They can see
video.
It.
Maybe they
we
can
are
see
on
it.
video.
Or maybe
YouTube.
there's. I don't
Say hi
know.
to YouTube.
YouTube. Yeah. Lori's answering these questions without notes, and we didn't rehearse any of this.
No.
I mean, the questions we're asking, she's answering from just rote knowledge. I think that's important. So I'm going to throw something else at you because why not?
All right, this will be good.
The bond market's concerned me for couple of years now. I think it's broken, but that's my word I'm choosing to use. So 2s10s have gone from flat, 111 basis points inverted, 38 basis points, back to 105, and I think as we're sitting here, we're either side of 70-ish. That doesn't speak to a particularly healthy bond market, but what people seemingly worried about, and I've actually read about this, it's not the inversion that scares people. That is scary in and of itself. It's the re-steepening of the yield curve where things start to get a little dicey. And we're seemingly in the midst of that. Unfortunately, it's because longer dated bonds have been going higher. And this week or last week, we heard from Bill Ackman who rang the bell within the context of short term, but he's betting that interest rates go a lot higher. Thoughts on that?
So look, I think over time, right, higher interest rates are going to suppress your PE multiples. Now, I think we're living in a moment in time when we're being jerked around a bit more by inflation, but it is a headwind, right? And, we've talked about my valuation model a little bit, which is telling me, kind of look for like 21.45 times the end of this year, 23.4 at the end of next year. And that's all predicated on a 10-year yield that behaves. So I do think, it is a risk, right? It is a risk to equity valuations. It's probably going to keep things choppy as we debate that issue for a while.
I asked you this last time. I asked this to pretty much every strategist that comes on. The love mail, the hate mail, the calls that you get, right? I want to ask you about that, and also conjoin that with, I know what you do track is sentiment.
Yeah.
And when you have a 30-point spread between bulls and bears, I think is when you kind of hit your maximum. What does that look like right now? And then tell me the hate mail or love mail that you're getting.
So the AAII, I have to think about the love and hate mail right now, but the AAII indicator, I used to work with Tobias Levkovich over at Citi, and, this was a big part of his process. And, something,
Legend.
Yeah, and he always taught me to be a contrarian, right? I mean, that was probably his greatest gift, was that willingness to take a contrarian stance. And so I've looked at this thing my whole career, and I redid the back test recently, actually. And one standard deviation above the long-term average is about 22 on the spread. And so we've crossed above that on the 4-week average. Over the next 12 months, and this is based on data going back to the 80s, you have about a 5% S&P 500 for return over the next 12 months. So it's not cataclysmic, right? But it does tell you you're setting up for a period of digesting. You're setting up for a rocky road. And sometimes that has been associated with very dicey markets. So, we put out a note, I think at the beginning of this week. It's been a long summer. And we basically declined to up our S&P target. And we said there may be occasion to do this later in the year. This is not the time. So we're sticking with the 4250. We have some models that are around 3,800, some models that get us up, a lot higher to 4,800. That's our valuation earnings work. The 4,250 is kind of the median or the average in between. So that's the base case. We've acknowledged the upside risk. This doesn't feel to me like a moment in time, given what I'm seeing on the sentiment, to push that upside case right now.
All right, so hate mail, love mail, what do you got?
The hate mail, I would say, I'm trying to think of
For the pushbacks, like, Lori, you're just not seeing it. You don't get it, or, I know you get both.
Yeah.
You get bears or bulls, but I'm just curious of if
I would say the interesting thing that we've found, going back to this valuation model, right? That's probably what I get the most inbounds on, and I think it's sort of indirect hate mail because people say, well, how can you possibly come up with this model that says we should trade at 20 plus times when bond yields are where they are, and we should be trading at 15, 16 times? And I kind of put my data nerd hat on and I say, oh, thanks for the question. And I do appreciate the question. And I say, look, I think you're probably just doing an analysis like a regression with the 10-year treasury yield. And, that's what post-GFC history will tell you. And I said, I built a data model going back to 1962. And we looked at all these, different factors. And we put a regression together. And we're layering in consensus expectations. And this is what it's spitting out. And it has about a 60% correlation over time. It's not a holy grail. It's a compass. It's not a GPS. It's going to get you to the right town, not to the right street address. But, it's been working over the last year and a half, and it's really been explaining what we've been seeing on the multiples. And by the way, I bet I know what you're doing every CPI day, which is sitting by your Bloomberg and waiting for the print. And that moderation in inflation is what is pushing the multiple up. And that's exactly what happened in the 70s and 80s. And by the time I get through all that, most people's eyes are in the back of their heads, and they're kind of appreciative of it. And I wouldn't say it fully convinces everybody, but they're like, okay, maybe I need to look at something else besides the bond yield.
So those are bears that are coming at you.
Yeah.
But your target's 4,250. So what are the bulls saying? They're saying you're saying don't worry about my price target. That's not the important thing. Look at my sector allocations. That's more important.
Yeah, the bulls, it's funny because even though I've got this target, that's we're a bit below where we are right now, I'm still considered to be relatively bullish. And I've kind of found that funny all year because I keep getting the calls of like, okay, you've been more constructive than most of the other strategists. What are you looking? What are you seeing? And we take them through the sentiment and the valuation and the earnings work. So I'm not getting a lot of pushback from the bulls. I think I'm talking to a lot of begrudging, I wouldn't even call them begrudging bulls, but kind of people who have been formerly bearish that are getting begrudgingly pulled into the market and just wanting help making sense of it.
You mentioned Tobias Lefkowitz, legend in our world. I think it was 2 years. I think it was October of 21 that he passed away. You probably know better than I. But what do you think he would? Because he was in front of so many different things. I mean, he was
Behavioral finance.
Behavioral finance, which that leads me to my question. What do you think he would make of this AI craze we've seen effectively for the last 4 or 5 months? I mean, that's about the right time frame.
That's a good question. I don't know what he would think about AI specifically, right? I mean, he was an old industrial guy and covered machinery and E&C stocks. So I think he would probably take the spin, and I heard a client say this, so this is not my original thought, but I heard someone make a pitch that AI, by sort of, kind of whittling away the jobs in the knowledge economy and the tech economy, and, was going to reinvigorate the old economy and the industrial economy, because you can't AI, kind of driving a truck, and you can't AI building a building. So I think he might like that spin as an old industrial guy.
Well, Lori, it's great to have you back on the tape. You'll certainly be back again, if not this year, early next year, and we'll continue to have these conversations. I know I can speak for Danny. Your work is extraordinary, which is why we love having you on, and why Fast Money is obviously a place that you like to call home from time to time as well.
I do. I like to come visit, and you guys are nice enough to have me.
And Guy, you've missed the biggest thing. She's a season ticket holder for the New York Giants. I mean,
wait a second. Hold on.
Yeah,
Wait,
so we're approaching football season, and
So
by the
where-
time you come
where did
back
that-
on, you will have missed the playoffs.
Where did that?
So
First of all,
okay,
you're wrong.
Okay.
Where did that come from? I mean, now we have to talk about. Do you have a love of the New York Football Giants?
I do. I married a local, so I grew up in the South.
Yeah.
But I married a guy who grew up in Rockland County and was a lifelong Giants
I
fan.
love that.
well, I grew up in the South and married a New Yorker. That didn't make me like any of these New York teams, but
Well,
yes.
well, when they built
Yeah.
the new stadium,
Which is a shithole, but
Yeah.
continue.
Yeah.
he had a little money left in his college fund that had never gotten spent, and so we spent it on a PSL and have our Giants tickets.
Sell those tickets early and often, Guy. Those are going to go down in value as the season progresses.
So just so Lori knows,
Yeah.
and now Danny's, this is going to be a big eat crow football season.
Great.
When the Giants drafted Daniel
Here
Jones,
we go again with this Daniel
I
Jones
loved
guy.
him.
Yeah.
Not now. I would say for every one person that loved him, there were 50 people that were like, "What are you talking about?" That is turning here. That worm has turned, and I'm going to tell you, Lori, that Daniel Jones is going to have his ratings, depending on what match, he'll be a top 10 quarterback in the National Football League this year.
Okay. Very good. That's not saying much about the other 22, but that are remaining. But that's fine.
Stick around. I'll put
Yeah.
it this way.
Yeah.
He'll have a better season, both in wins and losses, and statistically, than Aaron Rodgers, who plays in the same stadium for a different team.
Fair enough.
But Lori, we'll talk about that. Thanks for joining us. You're the best.
Thanks for having me.